Investors are rushing towards cash, but what does this mean for you as a trader and investor moving forward? Well, today we break down the data around how this has happened before and really understand whether the stats are as scary as you might think. We'll also be talking about everything to do with the FOMC event, non-farm payrolls, which is the jobs numbers in the US, and the biggest stock in the world has its earnings this week. But what might surprise you even more about this is the implied volatility. It's almost like there's nothing going on in the markets, and that's going to lead to, I believe, quite a lot of liquidity traps later on. Let's discuss our thought process leading into the big events, including the charts. Well, welcome back everyone to the Daily Show where we talk about markets around the world. If it's your first time here, welcome to the community. Consider subscribing and smash that like button if you find value in today's video. I'm sure you will. We've got a lot to discuss. We'll start with the news, the macro, the lead indicators, and then we'll get into the hottest charts. But let's begin with annual seasonality. So you probably heard of the saying sell in May and go away or run away or any of those types of things. But is it so true? Well, here we go through kind of the decades to understand whether the S&P 500 will sell off in May. If we were looking at the surface of the last 10 years, you would say no. May does tend to be a bit of a lackluster month, and we usually go into a sideways market. Sound familiar? It's almost where we are right now. Then we usually drive up. Now, this was what's happened in the last 10 years. But before those 10 years, if we go back over 25 years, there is some merit in the idea of selling in May. You can see the weakness at the beginning with some buying into the end. Over on Twitter recently, I shared 95 years of history for the S&P 500, and this is where the saying comes from. You can see that drive into the start of May, followed by a pretty large sell-off, usually in the vicinity of a couple of percent through that section. Then usually markets continue to go up and they find a lot of buyers. So does this help us? Well, unfortunately, not as much as we would think. If it's time for a sell in May, you would say this is the year it's going to do it because it hasn't done it for so long. But we need to find other triggers. It's not going to give us enough statistical advantage. If you see turnaround events in the markets, it can help to build your confluence or your story. And that's how you want to use some of the data like that. Let's talk about real money market funds, though. We discussed the idea that money is flying, and we're talking flying into cash. Look at these holding reports. We're basically seeing retail money market funds finding some of the strongest buying in decades. And you might think, well, this means that, of course, the markets are going to crash. Generally speaking, money market funds like this only rise at epic rates leading into recessions. So it's not like the market is not guessing there's a recession. I mean, the Federal Reserve of the US has literally told us they expect a mild recession. But should we be too scared about it? Well, let's look at the data here when we go back over all the points when this has occurred. You can see it's the second highest reading on record. The other one was around the 1990s. And you can already see based on the S&P, there's a little drop that happens after that. And I think that's an interesting point. So what happens when the S&P 500 triggers this? After retail money market assets grow over 20% year on year is the way we're going to read it. And you'll notice it's not as scary as you might think. The downside, though, is fairly significant, but some of the percentages positive, they've been massive. And you can see here the average actual amount that markets grow over this period has been very, very strong. So again, if we end up getting declines based on this data alone, it means that that money will eventually flush back into the market. So it kind of goes up and then it flushes. And of course, timing will be everything here. Where I found the stats way more interesting was when we talked about other asset classes. The 10-year treasuries do not fare well in this environment. We've also got the debt ceiling coming up. We've talked a lot about 10-year treasuries, but if the Federal Reserve sticks to their guns and they don't cut rates, 10 years will struggle. And we'll talk about that a little bit later on. Bloomberg Commodity Index also shows very weak markets for commodities. Again, not the best, and it goes with some of the stats we talked about in our previous weekend video, which we'll bring up in just a few moments. The US dollar doesn't tend to do too well over these periods of time as well, and gold is basically shocking in the next 9 months. 25% of the time only is gold up, and it's in line with some of the other things. So when we're talking about commodities, have we seen something that worries us? Well, yes, the Bloomberg Spot Commodity Index dropped pretty drastically recently, and this led us into some extra statistics that we can talk about here. We'll just quickly jump over these, but basically commodities don't fare well over the next 6 months. And you can see that when we're below this 35% line here, when all these commodity trends align, only 11% of the time does this happen, but usually the average return for commodities over that year is negative 15.8. And it makes sense. The Federal Reserve is trying to create demand destruction by raising rates. We expect raising rates of 25 basis points only in a few, literally a day and a bit. And pretty much we expect demand destruction across the board. Agriculture is also struggling. You can see here wheat, corn, soybeans, sugar, coffee, and of course chocolate. All things here are coming in, and basically they all show, again, very similar reads. Basically, it's not the time to own agriculture based on the stats alone and what's going on with central bank policy. So in light of this, what's happening on the markets? Well, let's discuss smart money versus dumb money. Basically, we've seen a bit of a switch here. Now, this is, of course, just an indicator. It doesn't mean that you're going to use it as an exact timing tool. And we've used it in 2022 and even 23 to show us times to be cautious in markets. When we got a read similar to this over here, where we had this huge discrepancy between smart money and dumb money, we had a feeling that markets would drop. Then we got the Silicon Valley Bank crisis and everything else. And we kind of find ourselves at a very similar kind of area into the FOMC and into two extreme zones on the S&P 500 we'll look at later on. Also, some notables. When we got crosses previously in things like August of 2022, it helped us to kind of build a confluence story for weakness around that time for swing traders in particular. Let's talk about greed, fear and greed index. We're seeing a little bit of greed. We've been as high as 70 on this reading recently. And of course, we've been a little bit in the neutral zone over the last week. But with this uptick into the FOMC, we're basically at a greedy level. Not an extreme greed, but certainly a greedy level. Now, here's something that's just been introduced to the markets, and this is the VIX one-day. If you've been following the markets for a while, you might know of OTTEs, and basically what's happened here is these are suppressing the normal fear/greed index, which is the VIX. So we've got these 1 days now, and what you'll notice is that generally speaking, we see an uptick the day before big news. We've been able to go back over a year worth of data here, and basically the volatility has always been increasing a day before the biggest events, the FOMC events and the CPI events, often considered the two most important events on the monthly calendars. And I'm surprised there is so low volatility. The complacency is extreme. Usually these readings here in terms of SPY term structure have been coming in at around 0.3 for both CPI and of course also FOMC events. Coming into this one this week, not only are markets hedged fairly effectively, which we'll talk about later when we discuss what the scenarios are here for the markets, but the FOMC itself is just the complete complacency coming in here. Everybody feels like, oh, it's a non-event, don't worry. Again, I always put up the cautious tail there and say, well, maybe we need to be protected over these periods of time, because when everyone else is complacent, I always get a little bit nervous in the markets. And it's mostly because it's not so much that I don't think markets go up over time. It's just that near-term risks become real. How bad has the earnings been? As we know, we're in earnings season. Well, with low expectations comes a lot of beats. So actually, a percentage of companies beating the EPS estimates is 79% taken as of last week. That's above the 5-year average. So is that the reason the markets are up? I don't really think so. I think the markets are up because 10 stocks in particular are driving it. And they are, of course, big tech. If we ripped out those 10 stocks from the market, as we'll see later on, we wouldn't actually have a very healthy market. And specifically, Russell 2000 and other areas are showing us that. What about Federal Reserve liquidity? This is something we've discussed in 2023 quite a lot. I believe it is going to be the most important read to basically follow. If the Federal Reserve live up to what they're meant to be saying, and I said this in the Monday stream, by the way, Monday streams are back. If you're interested, come and join us 1 hour before the markets open every Monday. We do the Monday Open, which is an awesome event. We've always got thousands of people that come out for it, which is great. And we've got some improvements coming forward. We'll have a terminal that we'll be talking about. We'll also have a whole bunch of flow discussion coming through. But let's just discuss this Fed concept. We'll look at the chart later on to see where the central bank policies are around the world right now in terms of injections or declines. But if the Fed lives up to its tapering name, and they're meant to keep tapering, we have to expect markets to fall in line with that at some point. And at some point is going to be the biggest discussion. S&P forward metrics, if you're an investor, do I like price? No. Do I love price? Not really. I think it's okay for investors if you're really bullish, but yeah, it's not really cheap. I like to get forward PE into that 15 kind of handle if possible. The average is somewhere between 16.8 and 17.5, depending on how long back you take it. And forward PE is the better PE to use. Remember, current PE is useless. Use the forward PE. And at the moment, the forward PE is based on fairly decent expectations from the street over the next coming year. They're not really pricing in that full recession or something going wrong with the economy yet. What is interesting, though, is how effective the markets are at picking apart the different companies. The Big 10, that's massively up. IWM or the Russell 2000, that's down heavily, and everything else is middling. So it's really a tale of almost three markets at the moment. They are all separate. Here's the earnings reports coming up. AMD is a big one. Of course, expected volatility between 7 and 8%. With the computer slowdown, will they beat expectations? We'll find out. But yes, it is expected to be a big volatility event. So definitely worth checking them out. Then we've got Apple as well coming out on Thursday. Now we know that's between 4 and 5% expected move. And I love this chart because it gives us that implied volatility. So you always want to have that leading into these types of events or earnings seasons. What's been winning the last 5 days? Communications, technology, no surprises to most of you out there. What is surprising though is that actually not when we find out JP Morgan and what happened there, but the regional banks are suffering, down 2.93% on the last 5 days. And in particular, they lost almost all of that in the last 24 hours. Why, you might ask? Well, JP Morgan is now the one, yeah? The moat on this bank, or the monopoly on this bank, has been extreme. Jamie has done a good job. And you've got to say, when you start to get past regulation in terms of how much you're allowed to own and how big you are, the competitive advantage, thanks to what JP Morgan just pulled off over the weekend, is incredible. No wonder their stock was doing okay. And you'd have to expect in the future that JP Morgan will be one of the strongest banks in the US economy, and they're just going to continue to be huge. Obviously, there's issues possibly in this takeover, but in general, I think it's a pretty good win for them. Semiconductors, XLI, XLV, and XLU, so it was no clear winner, whether it was defensives or not. And that's something that's important. Whenever we're looking at these charts, we're always looking for those signs. Last week on Tuesday, I think we had, before earnings, we had all three of the top sectors being defensive. The market then proceeded to tank around 3%. And then, of course, technology and all those other sectors came back, and we are where we are now. So let's get into the charts and let's get started talking about some of the key levels. We'll begin here with central banks around the world. This purple line here basically represents all of the money flow, and you can kind of see when you should be long and when you should be short. Now, it's not a perfect mechanism, but in general, if we're too far above this purple line, you have to start getting concerned. And if you're too far below this purple line, then it could be a great time to buy. And if you bring across a stat of confluence, other confluence techniques, including technical analysis, including fundamentals, including specifically forward PE and other things, you can really do well on the swing chart. I consider this more of a swing method. And where we are right now is we're in the extreme level 1 of the S&P 500. Yes, I've been bearish up here. Yes, I remain bearish until we break above key zones, which we'll discuss later on. But I think you have to also admit that if levels get through certain zones up here, we will flush or move to the next area. And what I think the FOMC event is going to do is more than likely trap liquidity. And that is where we go to patience, react, don't predict. It's going to be very difficult to predict here exactly what the FOMC is going to do. We'll go through that later on, but I know it's fairly hedged, and that's why there's complacency in the market. So if they unwind some of those hedges, it could create a bit of a bull spike in the markets. Now, if that bull spike does occur, and we go through some of these zones up here we'll talk about later, in particular just underneath the 4220. Once we close that, we're probably going towards 4300, 4350. If that occurs at these levels up here, I believe there's going to be a trap. So this will be it's an extreme zone for a reason. I believe there's a trap sitting here, and there could still be a trap around these levels as we look at it just a little bit soon. Let's go through if this market is healthy. First up, we have here the equal weighted index ETF. So the equal weighted index ETF is showing us that the market was unable to make a new high. It's still quite a lot weaker, and it just shows you that if you rip out the big top 10 tech stocks and weight them equally, there's just not much love there for the market overall yet. Here's another interesting chart. This is the NASDAQ versus equal weight. Now, when we tend to see these leaders come through, so you can see here, sometimes we get these leading kind of stocks, there's often a bit of a slowdown that occurs, and it's not a healthy sign for markets. So if we load the SPX over the top here, what we might see is that when we get these leading kind of markets for the big guys, and you get leads over here, that tends to be a bit of a problem. We tend to see a slowdown. Here's a notable one that happens. We get that big tech lead, the tech kind of drops off, and then, of course, the rest of the market comes with it. We also get a big tech lead here near the end, and we go choppy into downside. So that's where we find ourselves. Basically, the tech stocks are leading the show, and it's not always precipitative of a next couple of months being good. Usually, it's kind of a bit more kangaroo or naughty. Let's move over to the skew index. This I don't bring up very much because it tends to be a pretty poor indicator. But basically, the skew index shows us how hedged or how things are going into this. We're at 135, so there is expected potential volatility, but I will say that there's a bit to unwind if the big guys kind of choose to do so. If we move over here to the VIX 1 day, you can now put that on your charts, VIX 1D. This is the CBO 1 day. Put it on a line chart so you can read it like this. And this is just showing you how little volatility is leading in. Now, you would almost expect volatility to spike 1 day before the FOMC. And remember, the FOMC is theoretically on Wednesday. Well, it's not theoretically, it is on Wednesday. So should we expect volatility spike over the next 24 hours? Well, yes. Based on that chart before, you would expect it. And I'll post that over on Twitter if you're following us at FX Evolution so you can see it. Let's move over here to the Russell 3000. So the Russell 3000 just shows us breadth. Again, the market is coming up. It is weaker in terms of the amount of stocks coming through. Here's the VIX. It's just low. And the VIX is actually becoming useless. We'll probably move over to the 1 day quite a lot more. And we'll be talking about 0 DTEs up and coming. What about copper? Well, copper hasn't fallen through our lows, 3.82. I've mentioned it many times. I've been weak on copper for a while, which has been great for iron ore shorts. And in particular, that's something I do because I'm from Australia and iron ore shorts are good. So if you think about it, copper going underneath 3.7 is going to be a pretty critical level. If that does occur, we're probably looking at a slowdown in the economy, and I'd expect the market this to be basically a trigger signal for the market. So watch copper. We don't trade it. We just look at it, and we obviously use it for other reasons. What about bonds? Well, high yield junk bonds dropped off on the session. The stock market kind of drove up. It actually hit a Russell 2000 level, which is amazing. It was a great zone. Love the Russell 2000 on the weekend video. And then we saw some shorting occur. It's not showing us enough yet, but certainly a bit of weakness there. We also saw treasuries get hammered. So treasuries dropped 3% back underneath these levels. And I think a lot of this has to do with, well, yields really, and a movement in expectations. If we go over to the US 2-year plus debt ceiling concerns, US 2-year here, US 10-year, you'll notice they're not declining. They're basically holding firm as they find out what the FOMC event is going to do. We also know that treasuries, unfortunately, may face a little bit of headwinds based on some of the data stats we've brought up in the last couple of days. What about the dollar index? Well, the dollar index found some strength. The US dollar actually closed above this downward trend line. So you might think, well, now drops should be met by rallies. I do think the dollar is coming into a tough week to trade because we have the FOMC, big event for it. And also we have the non-farm payrolls. Based on this little closure here, based on the fact that it closed above these levels, you would have to think that maybe the US dollar is finding strength and drops will be met by rallies. And once it gets through something like a 102.210, then you would think that it's probably basing. And at the moment, it looks like a base. You can see the weekly here. It keeps holding up. Long leg doji, no break high. We'll wait for the dollar, I think. But yeah, that's one. Gold continues to look horrible on the trend line. I've mentioned several times I'm not a fan of this trend line anymore. We've used it effectively over here. But since we've got those lower highs, even with this spike up, and till gold through 2015, I have to believe it's weak at this point, and this trend line keeps holding, but for how much longer, I'm not sure. Again, FOMC and non-farm payrolls will clean gold up and make it easier to trade from that point. It's kind of like in a consolidation period at the moment. For the oil trade, I'm a bit sad about this one. I was really hoping that would hit this level. That was probably one of my favorite trades of the week. It didn't quite get up there. Some people will have shorted it here. Support becomes resistance. There's also supply in there. I did want it to spike that 77. Sometimes you got to be patient. Sometimes you miss your opportunity. This was a good one. Certainly in the direction of trend, I really liked it. How does it look now? I don't really think oil is too interesting. And now it's come back down to these take profit zones. So we'll come back to that as we get more. Let's move over to the stocks, and we'll start off with Tesla. So Tesla had a bit of a bad session. I'm not going to go, this thing's going to clean up the gap yet, because I still think it looks kind of weak on charts. We're looking for it to get past 166. If that happens, then we might look towards 180. At 180 in between this zone, I believe sellers will recommence. A lot of this will have to do with the FOMC, so we'll talk about that. But at this point, we're still looking for that gap fill. We've talked about it for ages and ages and ages. Tesla does look weak, along with other consumer discretionary. We'll actually just bring up consumer discretionary 1 here, which is, of course, Amazon. Close on its lows here. Let's have a look. Close on its lows. You can see it respected this downward trend line. And this is the tale of two markets. Amazon is not performing well. Tesla is not performing well. It's clear the markets understand the American consumer, which is 1/3 of the US economy, is starting to get sick. So are the markets incorrect? Well, the markets, I believe, are literally betting purely on the Federal Reserve supporting. And since the Silicon Valley Bank crisis, they're projecting that the Federal Reserve will not taper enough. And they've been correct so far. So if you're a bear in the markets, you have to believe that the Federal Reserve is going to stick to their dot plot. That is, they're going to hike and they're going to hold rates high. Only then, and they're not going to come in and just bazooka the market constantly with tons of stimulus. If they bring stimulus in, I'm telling you, the bears will have to give up. And that's, being flexible in markets. That's what it is. Let's talk about where we are, though, at this stage, because the bears haven't technically given out yet. Let's go to the NVIDIA here, and it's right in our reaction zone. It actually took the high and then came back in. Geez, I tell you what, this is a level I've been waiting for a while. The markets came up. Oh, the risk reward on NVIDIA is starting to become obscene. It's in the run is so good. I understand the stock is on a heater. You go to a weekly, you say, wow, look at this thing. It's so beast mode. Yeah, I love the stock. However, it is really in that level before the FOMC event. So yeah, if this then does, basically if we fail here and we come down, then we've got a clear wipe-off distribution, and we know what happens next. It will dump and it'll be on. So there are some, I call these exciting levels. I even posted this to the community. I said, damn, that zone finally hit. I got my alert this morning on NVIDIA. I went, whoa, there it is. Okay, well, that happened probably a day earlier than I expected. I actually expected this to spike during the FOMC event and then potentially find weakness. But it is where the bears would be looking at it. Now, taking shorts or taking longs, in particular taking shorts, the dangers of that into a complacent FOMC event are big. So you've really got to consider your instrument selection. I mentioned this on the weekend video. If you were thinking about shorting the market at this critical zone, you'd have to use options, because you just can't risk some of these stop loss level hits and the liquidity zones that could occur. Let's move over to the Australian market. For the Australian viewers out there, we got a switch of trend on the first time frame. It's still, of course, an upward trend on the higher time frames, but that's exactly where I expect the weakness to come back in. Basically, we just go with a fib here, and you might notice that we get that kind of 61,875. That's pretty much normal where you'd expect it to short off. And as long as copper keeps failing, if copper goes to new lows, you've got to expect weakness on the Australian market. Overall, the banks should be okay. Obviously, it's more about I think the bank strength in Australia is really good. So that's where bonds, I believe, have been very, very strong. We'll move over to the DAX here. Let's look at the daily. It's no signs yet of weakness, though it could still be distribution. This could be still kind of more of the UT, and then we come back down, and look, if we get the switches, we'll know what's occurring. But at this stage, DAX is heavily shorted by retail traders. And look, with candles like that, you're not going to say, wow, that thing's weak just yet. It's just not going to happen. Let's move over to IWM. This was the trade of the session, I believe. It was an excellent position. You can see it comes up to fill that gap in here. That's the real market ETF. But take a look at this. This is on the weekend. I put this zone together. I did say it's probably my favorite. Excellent Monday trade. I said it in the live stream as well. This is the type of level that I'm really looking for. That's that replicatable zone. You know, maybe Friday's session might have been a pretty good zone as well. I would have classed that as a 7 out of 10 short. This is also a 7 out of 10 short. So, you know, it's happened. It's come through. It's done pretty well. You can see it now as a shooting star. Will it continue down? I'd actually favor this if the market rallied first. And I'll talk about that in just a few seconds. Basically, I prefer the markets to, maybe not the Russell 2000, but the S&P in particular, to rally first before the market open. If you've been watching the market over the last 2 weeks, it's often the move, like if it rallies in and creates the gap that end, then it will often find bears. If it's been dumping in, the bulls have been taking control. And that's at the futures market has really been dictating that. Let's look at the Qs. Nothing to speak about here, really. A high, a low, an open, and a close. Long leg doji ahead of the FOMC. So no action there. We do have a lot of gaps now on the downsides. You can see this gap has been filled. I've had watch reaction here for a while, and this being my red box for potential false breaks. But I think the S&P offers the best false break levels. So we'll look at that in just a second. Here's the US 100. You can again see the way it's reacting. A lot of people will consider this breakouts. I think the risk into the FOMC is pretty real. If the markets do something like this, though, which we'll discuss in a second, once they make that new high, we're moving into these areas up here, which we'll talk about soon. Let's move over to the SPY. You can see, again, critical level where we're at. Expected high and low of options. Interesting, the high sits on the gap fill. Let's move over to the SPX. Here's the SPX. I've added the 20-day moving average onto this. If markets were able to get underneath that, so the markets, it's about 41.22, I think, actually. So just remember that number. But if markets get underneath the 20, I think that might bring in some squeeze shorts. And we'll discuss that in the next video ahead of our FOMC kind of overview. Let's go to the US 500 futures. Okay, so 41.22, what is that? Well, it's right where our heavily traded zone is. So the 20 moving average will be sitting on the heavily traded zone, which will also be between what I like to consider the fair value and the cheap range of this demand. So if markets do find a rally into weakness, which is kind of my leading theory here, then we probably end up around 41.28, 41.22 as an interesting zone where buyers may try to recommence. I don't expect huge breakouts. It's always possible, of course, before the FOMC. But yeah, our level held again. So this is the 41.77 high. The markets, as I expected, would go up during the session, which we talked about in the live stream. I was looking for them to come up here for a day trade kind of towards the short side. If we saw the turn, that is what occurred. And if we go down to the 15-minute structure here, although it's a little bit hard to read, we did get a small change of trend on the very small timeframes. So rallies again, most likely pressured down ahead of the FOMC because we know that 1 day IV usually spikes before. So if that spikes before, that would usually say downside. During the FOMC event, join us, make sure to subscribe for this one. It's going to be a big one. We usually see kind of the initial reaction be the wrong reaction, and then often the right reaction to be whatever the hell Jerome Powell's saying. And he has generally driven markets higher, if you can believe it, than lower. But at this stage, I favor the idea. I'd like to see markets come in more bullish, then kind of drop, come back to the heavily traded zone area around here, and then possibly find those buyers to really put us back in this level. When that occurs, the key zones that I've detailed out here, 42.17 in particular, I've always had this on the chart. A close above here is big. I think once that finishes, we are moving towards 41.80 has always been a big zone for me, but 42.17 in particular, that is the high of a previous period. Around that zone, if we close above that, we're probably moving to the next extreme zone, which brings us up to here. And if we keep seeing central bank policy low, markets going higher and driving into this level, I do think there's going to be some serious complacency up here if we get there, where bears will really have a go at it. So this is my super zone. I mean, I've been waiting for that for a long time. If you've been entering shorts, of course, it's been frustrating. It's all about timing, guys. Over the next 24 hours, I'm going to start talking about short time, mid, and long. Of course, long, I'm usually going to be bullish in markets unless residential property is getting cracked. And if that happens and it was leading it, well, I'd be under the table with a bunch of puts just saying, okay, I'll see you in 18 months. But at this stage, that's not what's occurring. Commercial's bad, but not residential. Let's look at the overall markets here in terms of options. It is pretty well kind of slapped on both sides. You can see the 425s. A lot of calls came in last week near the end. So we saw a lot of buying as people started to feel that FOMO, as we reported on. And really 415, 425, that's where the call strikes are. And of course, 405, 400, that's where the put strikes are. We're sitting smack bang in the middle of both of these. So not much to say for now, but if either side is broken heavily, the 20, or of course above that 42.20 kind of 17 zone, then we should have a breakout and a few swift days of big movement. We'll talk about that ahead of our FOMC preview. What about Bitcoin? It's back down in a pretty heavily traded level. Difficult to read the next move for Bitcoin. If we go to the weekly here, you can see that if we do end up closing underneath this white line down here, I'd say bears are in control. And I would expect non-farms and the FOMC event to be very big for crypto. It has been in the past. Crypto often moves. If we delete that for a second, if you're looking just at the price action, of course, it looks weak. But this is where buyers have recommitted in the past. So you got to be a little bit careful here. Small time frames will prevail, I think, on crypto. If you're day trading, taking stuff into the FOMC event is going to be a bit risky. So what's happening first? Well, we've got, of course, the FOMC statement here and ISM Services PMI. These are all New York Times. FOMC press conference 2:30. And then we scroll down and through, we get the non-farm employment change on Friday. It's a massive week. I really hope we get some clean direction outside of this trap zone. And that's just mostly so that we can see and plan around those next levels. Plus, there'll be some momentum moves. We almost got a squeeze indication switch to the downside. I'm telling you, it was so close last week. So if you're interested in that video, we'll put that out tomorrow. As always, if you enjoyed today's video overall, make sure to subscribe, smash that like button, and of course, you can join us on the other socials over here and get access to a free cheat sheets if you're interested. Thanks so much, everybody. See you in the next one. Bye for now.